Have you ever laid awake at night staring at the ceiling, wondering if the decisions you made with your money today will haunt you tomorrow? It is a heavy feeling, that specific type of anxiety that tightens your chest when you see a line on a graph turn red and point downwards. You are not alone in this. In fact, you are part of a vast majority. But what if I told you that the difference between the panic you feel and the calm assurance of a billionaire is not about intelligence, and it is certainly not about luck? It is about avoiding one specific fatal mistake that 99% of investors make. A mistake so subtle, yet so destructive, that it has wiped out fortunes faster than they were built. Today, we are going to deconstruct the mind of Warren Buffett, the Oracle of Omaha, to uncover this error and, more importantly, to learn how you can insulate your life against it. Warren Edward Buffett is not just a man with a lot of money. Born in Omaha on August 30th, 1930, he has lived through wars, recessions, bubbles, and crashes. He has seen the world change from the age of radio to the age of artificial intelligence, and through it all, his strategy has remained unshakable. He is widely considered the most successful investor of the 20th century. But why? Is it because he has a secret algorithm? No. Is it because he has inside information? Absolutely not. It is because he understands human nature better than he understands balance sheets. He knows that investing is not a game of numbers. It is a game of temperament. And this brings us to the core of our conversation today. We are going to explore why your brain is hardwired to lose money in the stock market and how you can rewire it to build generational wealth. Let us start with a question that might seem simple, but is actually quite profound. Why do you invest? Is it to get rich? Is it to secure your retirement? Or is it to prove something to yourself or others? Most people, if they are honest, invest because they want freedom. They want the freedom to do what they want, when they want, with whom they want. But the fatal error occurs when the desire for that freedom turns into impatience. The error that 99% of people make is confusing activity with productivity. We live in a world that rewards speed. We want faster internet, faster delivery, faster food, and faster results. But in the world of wealth accumulation, speed is often the enemy. Warren Buffett famously said that the stock market is a device for transferring money from the impatient to the patient. Think about that for a moment. Are you the one donating your money, or are you the one receiving it? To understand this, we need to look at the biology of your brain. When you see your investment go up, your brain releases dopamine. It feels good. It feels like winning. You feel smart. You want to do it again. But when you see your investment go down, your amygdala, the fear center of your brain, lights up. This is the same part of your brain that would activate if you were being chased by a tiger in the jungle thousands of years ago. The pain of losing money is psychologically twice as intense as the pleasure of gaining money. This phenomenon is called loss aversion, and it is this biological mechanism that drives the fatal error. When the market drops, fear takes over and people sell. They sell because they want the pain to stop. They sell at the bottom, cementing their losses. And when the market is euphoric and everything is green, greed takes over, and they buy at the top. They buy because they do not want to miss out. This cycle of buying high and selling low is the exact opposite of what you should do, yet it is what almost everyone does. Warren Buffett operates differently. He follows two simple rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, taken literally, this sounds impossible. Every investor sees the value of their holdings fluctuate. But Buffett is not talking about daily price changes. He is talking about permanent loss of capital. He is talking about making decisions so foolish that the money is gone forever. To avoid this, you must understand the concept of the margin of safety. Imagine you are building a bridge. You calculate that the maximum weight the bridge will ever need to hold is 10,000 pounds. Do you build the bridge to hold exactly 10,000 pounds? No. You build it to hold 30,000 pounds. That extra capacity is your margin of safety. In investing, this means buying assets for significantly less than they are truly worth. If a company is worth $1, you try to buy it for 60 cents. This way, even if your calculations are slightly off, or if something goes wrong, you are unlikely to lose money. Most investors ignore this. They buy the stock that is popular, the one that is already expensive, assuming it will go higher forever. They drive the bridge that can hold 10,000 pounds with a truck that weighs 15,000 pounds, and they are surprised when it collapses. Let us dive deeper into the power of time. Einstein is often quoted as saying that compound interest is the eighth wonder of the world. He who understands it, earns it. He who does not, pays it. Warren Buffett's net worth is a testament to this. More than 99% of his wealth was earned after his 50th birthday. Think about that. If he had retired at 60, you probably would never have heard of his name. His secret weapon was not just high returns, it was time. A very long hill and a lot of wet snow create a massive snowball. Most people interrupt this process. They plant a seed, water it for a week, and then dig it up to see if the roots are growing. By doing so, they kill the plant. Investing is like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. But if you want wealth, you need to embrace boredom. Real investing is boring. It is about discipline and consistency over decades, not days. I want to take a brief moment to connect with you directly. If you are finding value in this breakdown of Warren Buffett's philosophy, and if you want to be part of the 1% who actually apply these lessons, please take a second to click the like button. It helps this channel grow and allows us to bring more in-depth content to you. Also, make sure you are subscribed so you do not miss the next video where we will analyze other financial giants. And here is a small request. Go to the comment section right now and write the phrase, "I am a long-term investor." Writing it down is a psychological commitment. It signals to your brain that you are shifting your identity from a speculator to an investor. Do it now. Simply type, "I am a long-term investor." Now, let us get back to the core of the issue. We talked about patience, and we talked about fear, but there is another element to the fatal mistake, following the herd. Humans are social creatures. We find safety in numbers. If everyone is buying a certain cryptocurrency or a specific tech stock, our brain tells us it must be the right thing to do. We fear being the outcast. But in the world of finance, the crowd is almost always wrong at the extremes. When everyone is optimistic, prices are high and future returns are low. When everyone is pessimistic, prices are low and future returns are high. Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." This is incredibly hard to do. It requires you to stand alone. It requires you to buy when the news headlines are screaming about the end of the world. It requires you to sit on your hands and do nothing when your neighbor is bragging about making 50% on a risky trade in 2 weeks. Let me give you a concrete example from history. During the dot-com bubble of the late 1990s, technology stocks were soaring. Companies with no profits and barely any revenue were valued at billions of dollars. Everyone was buying. It seemed like easy money. Warren Buffett did not buy. He was criticized. People said he was old, that he had lost his touch, that he did not understand the new economy. He simply sat there and stuck to his circle of competence. He knew that eventually reality would matter. When the bubble burst in the year 2000, trillions of dollars of wealth evaporated overnight. People lost their life savings. Buffett, meanwhile, had capital ready to deploy to buy quality companies at bargain prices. He avoided the fatal mistake of the fear of missing out, or FOMO. This concept of the circle of competence is vital. You do not need to be an expert on everything. You do not need to know how to value a biotech company, a blockchain protocol, and an oil rig. You just need to know the boundaries of what you know and what you do not know. The size of your circle is not very important. Knowing its boundaries, however, is vital. Many investors wander outside their circle because they see others making money there. They buy things they do not understand, hoping for a miracle. This is gambling, not investing. If you cannot explain how a business makes money to a 10-year-old child, you probably should not be investing in it. Stick to what you know. If you understand real estate, focus on that. If you understand consumer goods, look there. There are no called strikes in investing. You can stand at the plate and watch thousands of pitches go by. You can wait for the one pitch that is right in your sweet spot, and only then do you swing. The crowd will yell at you to swing at everything, but the crowd is not managing your bank account. Another aspect of the fatal mistake is the obsession with price rather than value. Oscar Wilde once defined a cynic as a man who knows the price of everything and the value of nothing. This applies perfectly to the stock market. Every second of every trading day, the market offers you a price for thousands of companies. But price is what you pay. Value is what you get. Just because a stock price has gone down does not mean it is cheap. And just because it has gone up does not mean it is expensive. You must learn to value a business as if you were buying the whole thing. If you were going to buy the local bakery in your town, you would ask to see their books. You would want to know how much profit they make, how much debt they have, and who their competitors are. You would not just look at a fluctuating number on a screen. Yet when people buy stocks, they often skip this due diligence. They look at a chart, see a pattern, and make a bet. This is not investing. This is speculation. Let us talk about the emotional resilience required to hold an investment. There is a famous study about delayed gratification called the Stanford marshmallow experiment. Children were offered a choice, 1 marshmallow now or 2 marshmallows, if they could wait 15 minutes. The children who could wait ended up having better life outcomes in almost every metric, from health to financial success. Investing is the ultimate marshmallow test. The stock market is designed to tempt you to eat the single marshmallow today. It tempts you with daily news, terrifying headlines, and the constant noise of pundits predicting a crash or a boom. Warren Buffett lives in the same house he bought in 1958 for $31,500. He drives a modest car. He eats breakfast at McDonald's. He does not need the marshmallow now. He derives pleasure from watching his capital grow and compound. He has disconnected his happiness from his spending. This disconnection is crucial. Many people make the fatal mistake because they are trying to fund a lifestyle they cannot afford. They take excessive risks in the market, hoping for a windfall to buy a luxury car or a bigger house. When you need the market to give you money to pay your bills or feed your ego, you are in a vulnerable position. You become desperate, and the market smells desperation. It punishes it. You need to structure your financial life so that you never need to sell your investments at the wrong time. This means having an emergency fund. It means living below your means. It means having cash on the side. Buffett always keeps billions of dollars in cash equivalents. Some criticize him for this, saying that cash is a drag on performance, but he views cash as an option on the future. When the market crashes and everyone else is forced to sell to survive, Buffett is the one with the cash to buy. He provides liquidity when it is most needed, and he gets the best deals of the century because of it. Let us address the modern investor's dilemma. We are bombarded with information. In the 1950s, you had to wait for the daily newspaper to check stock prices. Today, you have a supercomputer in your pocket that updates every millisecond. This abundance of information has created a deficit of attention and a surplus of anxiety. Studies show that the more frequently you check your portfolio, the more likely you are to trade, and the more you trade, the lower your returns generally are. This is due to transaction costs, taxes, and most importantly, bad timing decisions. The fatal mistake is thinking that doing more leads to getting more. In many professions, this is true. If you are a bricklayer, laying more bricks means more money. If you are a salesperson, making more calls means more commissions. But in investing, inactivity is often the most profitable action. It is about making a few great decisions in a lifetime and then sitting on them. Charlie Munger, Buffett's late business partner, said, "The big money is not in the buying and selling, but in the waiting." Consider the concept of ownership. When you buy a share of stock, do you see it as a piece of paper or a digital entry that you hope to sell to someone else for more money next week? Or do you see it as partial ownership of a real business? If you owned a farm, you would not look at the price of the land every day. You would look at the crops. You would look at the weather. You would look at the harvest. You would know that some years are good and some years are bad, but as long as the farm is productive, the value will be there. The fatal mistake 99% of investors make is treating stocks like casino chips instead of productive assets. When you adopt the mindset of a business owner, the daily volatility becomes noise. You stop caring if the market is up or down 1% today. You care about whether the companies you own are selling more products, increasing their earnings, and treating their customers well. We must also discuss the role of humility. The market is a humbling machine. The moment you think you have figured it out, the moment you feel arrogant is usually the moment right before you lose money. Buffett is incredibly humble. He admits his mistakes freely. He talks about the companies he missed, the errors in judgment he made. This intellectual honesty is a superpower. Most investors try to hide their mistakes, even from themselves. They blame the market, the government, the central bank, or their broker. They refuse to learn. By refusing to accept responsibility, they are doomed to repeat the same error. To avoid the fatal mistake, you must keep a journal. Write down why you bought a stock. Write down what you expect to happen. If it does not happen, go back and read your notes. Was your analysis wrong? Did the facts change? Or were you just unlucky? You cannot improve what you do not measure, and you cannot learn if you are not honest with yourself. Think about the best investment you can make. It is not a stock. It is not real estate. It is not gold. According to Buffett, the best investment you can make is in yourself. Anything you do to improve your own talents and skills cannot be taxed, and it cannot be inflated away. If you are the best at what you do, you will always command a share of the economy's production. During times of high inflation, your skills are your hedge. Yet many people spend hours analyzing stock charts and 0 hours analyzing their own career trajectory or skill set. They look for external solutions to internal problems. They want the market to make them rich, so they do not have to work on themselves. This is a backward approach. Build your earning power first. Use the stock market as a place to store and grow the surplus of your labor, not as a replacement for your labor. Let us revisit the idea of risk. What is risk? Academics in finance define risk as volatility, how much a stock price jumps up and down. Buffett disagrees. He defines risk as the possibility of permanent loss of purchasing power. A volatile stock that goes up and down but eventually doubles your purchasing power is not risky to a long-term investor. A stable bond that pays you a fixed interest rate while inflation eats away half of its value is incredibly risky, even if the price never fluctuates. The fatal mistake is avoiding volatility at the cost of accepting guaranteed erosion of value. People keep their money in savings accounts earning 0.1% interest because they are afraid of the stock market. They feel safe because the number in the bank does not go down. But in real terms, They are losing money every single day due to inflation. They are slowly bleeding to death financially, but because it is not painful in the short term, they ignore it. You must embrace the volatility of the market as the price of admission for superior returns. Now I want you to visualize your future self. Imagine it is 20 years from now. You are looking back at today. Will you regret that you did not buy that one hot stock that everyone was talking about? Probably not. Will you regret that you did not stay consistent? That you let fear drive you out of the market during a correction? That you interrupted the compounding process? Yes, you absolutely will. The pain of discipline weighs ounces, but the pain of regret weighs tons. We are constructing a mental framework here that is designed to withstand storms. The economy will crash again. There will be another recession. There will be another crisis. These are not bugs in the system. They are features. They are inevitable. The question is not how to predict them, but how to prepare for them so that when they happen, you are not one of the 99% who panic. There is an interesting psychological trap known as confirmation bias. Once we make a decision, we only look for information that supports that decision and ignore information that contradicts it. If you buy a stock, you will subconsciously seek out positive news about that company and dismiss negative news. This blinds you to reality. Buffett actively seeks out the bear case. He wants to know why he might be wrong. He surrounds himself with people like Charlie Munger, who was known as the abominable no-man, because he would constantly shoot down Buffett's ideas. You need a devil's advocate in your life. You need to challenge your own assumptions. If you cannot argue the opposite side of your investment thesis better than the person holding that view, you have no business holding the investment. Another component of the fatal error is the inability to sit still. Pascal said, all of humanity's problems stem from man's inability to sit quietly in a room alone. In investing, this manifests as overtrading. Your broker loves it when you trade. The taxman loves it when you trade. But your portfolio hates it. Every time you sell a winner to buy a potential winner, you are interrupting the tax-deferred compounding of your capital. You are paying taxes on the gain, which leaves you with less money to reinvest. Over 30 or 40 years, the difference between a portfolio that is churned constantly and one that is left alone is astronomical. We are talking about millions of dollars in difference simply due to friction costs and taxes. The fatal mistake is thinking you are smarter than the math.